Good morning and welcome to the Bulls, Bears, and the Bell morning edition of the Deep Dive. Thank you for joining us. If you're tracking the screens right now, well, there's this undeniable atmosphere settling over the market, isn't there? Ahead of the opening bell. Our mission today is really to cut through that complexity, synthesize the critical data points we're seeing, and distill exactly what's driving investor sentiment right now. Because honestly, the central mood is defined by one heavy word: caution.
Yeah, that caution is palpable. And, the initial read from global assets, it's pretty unambiguous. We are looking at a classic risk-off sentiment really dominating the pre-market this morning. And this isn't just like slight uncertainty. This is an active repositioning. People are moving money around in anticipation of what looks like a challenging session. To understand why, we really have to look at the three major interconnected forces that are sort of colliding right now.
Okay, let's unpack this. This structural weakness. Driver number one sounds like the most painful one, especially for portfolio managers who've been relying on tech leadership. A sharp, sudden weakness there.
Correct. Driver one is absolutely the tech sector. It's been wounded by really a combination of disappointing quarterly results and maybe even more damagingly, some very cautionary forward guidance from industry giants. I mean, the immediate brutal repricing of Netflix overnight, that's the headline event, right? Stemming from an earnings per share miss that the market just refused to forgive. But the chilling effect, it goes deeper. It extends deep into the supply chain. We're seeing major pressure from Texas Instruments, TXN, a massive bellwether for analog chips. Their outlook has cast a definite pall over, high valuation technology, semiconductor sectors. It's fueling fears of a cyclical downturn in chip demand.
You mentioned the market has zero tolerance for imperfection. We should probably pause on that. Why is that the case right now? Why does a seemingly minor miss lead to a 10% haircut overnight?
That's a really crucial question, and it speaks volumes about the elevated cost of capital environment we're in right now. For the past decade, maybe more, high-growth tech stocks were priced assuming, well, perpetual flawless execution and a very, very low discount rate. Almost free money, right? When the Federal Reserve and other global central banks pivot toward tightening, which they clearly have, the cost of borrowing goes up. And the discount rate applied to those future earnings, it shoots up too. So a tax dispute, an accounting anomaly, even a tiny revenue miss that might have been, frankly, ignored a year or two ago, now it gets severely punished because those future earnings, which are valued less now anyway because of the discount rate, they're not materializing flawlessly. The market is demanding a perfect premium for these high valuation stocks, and, well, Netflix failed that test spectacularly.
Okay, that sets the stage perfectly for driver two. And this creates a fascinating tension, doesn't it? This incredible divergent earnings volatility. The macro picture is gloomy, but you zoom in and certain companies are just exploding higher.
Exactly. It creates this really bifurcated market. It's intensely selective right now. While the broad market futures are, screaming sell down at the individual company level, bottom-up fundamental execution is proving absolutely paramount. This is where active management, frankly, earns its keep. We have these examples like Vicker Corp, VICR, and Winnebago Industries, WGO, both indicating pre-market gains well north of 25%. It shows us that the market isn't just indiscriminately selling everything. It's distinguishing between companies failing to manage expenses or guide properly, like Netflix perhaps, and those executing flawlessly against this very uncertain macroeconomic backdrop. So investors are fleeing broad index exposure and chasing demonstrable performance where they can find it.
Which brings us neatly to the third major driver, that macro anticipation, sort of the invisible hand guiding risk appetite right now. What's coming down the pike this week that has everyone so cautious?
Yeah, the market is unequivocally positioned around the macro data. We're effectively in a holding pattern, really, ahead of Friday. Now, today, Thursday, brings the initial jobless claims report. That's a crucial, timely snapshot of the labor market. Always important. But the main event, the one everyone's truly waiting for, remains Friday's critical consumer price index, the CPI report. That inflation data, honestly, is the sole factor right now with the power to either validate this current risk-off move or potentially reverse it completely, because it dictates the Fed's maneuvering room.
So we have a clear battleground set for today then. Negative top-down sentiment fueled by valuation fears, tech disappointment fighting against these really powerful bottom-up catalysts from individual companies just crushing estimates. Let's dive into the actual market data now. Confirm this capital rotation you mentioned.
Okay, let's start with the global pulse. The data flow, starting in Asia overnight and transmitting through the European session, confirms a pretty unambiguous picture of impending weakness across all the major U.S. indices.
And focusing right here on the U.S. futures, it's definitely a sea of red this morning. The NASDAQ 100 futures leading the charge down, which, given that tech sector weakness we discussed, is precisely what we'd expect, right?
That's exactly where the pain is concentrated. The NASDAQ 100 futures, the NQZ25 contracts, NQ for NASDAQ, Z for the December contract, 25 for the year, they're signaling significant pressure on tech, indicating a drop that's been fluctuating quite a bit, actually, but firmly in the range of, say, 0.89% to maybe 1.4%, trading around 25,000 to 40. This pronounced underperformance is the direct reflection of that Netflix news and the Texas Instruments disappointment. The sellers are absolutely signaling their intentions before the cash market even rings the bell.
Okay, and the Dow Jones futures, that's more your industrial value-type stocks, also firmly in the red, down about 0.92% near 46,720. So why is the relative performance of the Dow versus the NASDAQ so crucial here? What does that tell us?
The divergence. That performance difference is probably the single most important clue in diagnosing how capital is flowing right now. The Dow is performing slightly better than the NASDAQ. I mean, it's still down significantly, but relatively speaking, it's holding up better. This isn't just random noise. This is the structural footprint of an active, strategic repositioning. A massive, systematic risk-off rotation is underway. Money is actively being pulled out of high-duration growth technology, heavily weighted in the NASDAQ, of course, and simultaneously being reallocated toward more value-oriented, industrial, cyclically defensive names, the kind of stocks that have a larger weighting in the Dow.
Got it. So while the S&P 500, which is down, 0.52% to 0.78% near 6,737, reflects that broad caution, the underlying mechanism isn't just panic selling everywhere, it's rotation. What about the smaller companies, the Russell 2000?
Yeah, the Russell 2000 futures, the RTYZ5, they're also showing distinct weakness this morning. This acts as a confirmation signal. It confirms that this risk-off sentiment is pervasive. It's not merely isolated to large-cap tech, and weakness in small caps is generally viewed as a negative sign for the domestic economy. These smaller companies are often more reliant on internal economic strength, and they're particularly sensitive to higher interest rates and economic uncertainty. So yeah, not a great sign there.
Let's look overseas quickly. You mentioned Asia set a bearish precedent. How badly were they hit overnight, and what were the main drivers?
Asian markets closed broadly and pretty decisively lower. They were reacting to the negative close in the U.S. yesterday and, frankly, anticipating the tech pain we're seeing now. Japan's Nikkei 225 plunged quite sharply, falling somewhere between 1.3% and 1.71%. The drivers there seem to be a mix of profit-taking after a decent run-up, amplified by growing geopolitical concerns, specifically renewed tensions between the U.S. and China. That always spooks investors in those export-reliant sectors. Elsewhere, Hong Kong's Hang Seng Index declined by about 0.94%, and China's Shanghai Composite posted a loss of around 0.66%. So, broad weakness.
And how did that weakness then hand over to Europe? Was it just an indiscriminate sell-off there, too?
Europe received a mixed but largely negative handover. Germany's DAX, for example, is trading lower, down 0.74%. The broader Euro Stoxx 50 is down about 0.56%, so that reflects the overall cautious mood following the U.S. futures dip. However, and this is fascinating, the true outlier, and a brilliant confirmation of our rotation thesis, is the UK's FTSE 100.
The FTSE is actually up. How is it managing that? Why is it defying this gravitational pull of global tech weakness?
Right. The FTSE 100 is standing out with a pretty robust gain, around 0.93%. This is critical, and it relates directly to its index composition. The FTSE has a very heavy weighting toward commodity-related companies, major energy producers like Shell and BP, big mining companies, financials. These companies are benefiting directly from two key trends right now. First, the flight away from high-duration growth stocks, and second, that massive surge we're seeing in crude oil prices. It positions them as an inflation hedge. So the FTSE's resilience is almost the physical manifestation of the rotation out of the NASDAQ and into energy and value.
That FTSE insight, that's a perfect bridge to our next segment, decoding sentiment through these cross-asset indicators. If capital is rotating defensively, we should see that reflected across the VIX, commodities, currencies. Let's start with the fear gauge, the VIX. What's it telling us?
Okay, the VIX, the CBOE Volatility Index, it closed up over 4% in yesterday's session, settling around 18.60. More importantly, VIX futures are trading elevated this morning, pushing above 19 in the pre-market action. What this signifies is a sharp increase in investor anxiety and, practically speaking, an increase in the demand for portfolio protection. Investors are paying more for options contracts to hedge against potential downside risks.
Okay, the VIX is up at 18.60, maybe 19. That isn't 30 or 40. We need to give the listener some context here. Does this level signal outright market panic, or is it something else entirely?
That's a vital distinction. It signals heightened alert and, I think, tactical planned repositioning. It is absolutely crucial to recognize the VIX remains below that key 20 threshold. Breaching 20 often marks a more structural breakdown in market confidence. And it's certainly well below the 30-plus levels, which are historically associated with a genuine financial crisis or, outright panic. So what this VIX level tells us is that the market seems to be reacting rationally to known specific quantifiable catalysts, namely these earnings misses from bellwethers like Netflix and TXN, rather than some unknown systemic threat lurking out there. Investors are nervous, yes, but they don't appear to be running blindly for the exits just yet.
That measured fear you're describing connects perfectly to this commodity divergence we're seeing. Powerful strength in oil, but gold is kind of subdued. How do those two trends confirm the tactical nature of this rotation?
Yeah, this divergence is really key to understanding the current capital flow. First, the oil surge is undeniable. West Texas Intermediate WTI futures, they're up by more than 3%, trading near $59.35 a barrel. Brent crude, the international benchmark, is showing even greater strength, up over 4.4%, near $64.38 per barrel. This is directly fueling that energy sector strength we talked about, the FTSE performance, etc.
But traditionally, right, if investors are really scared, they run to gold. It's the classic flight to safety asset. If this is truly a risk-off environment, why isn't gold soaring alongside oil?
Because the anxiety appears to be highly specific, not systemic. Gold futures are actually trading slightly lower this morning, down about 0.45%, near 4,106 sticks per ounce. This really confirms that the current anxiety is more of a tactical de-risking from equities, and specifically from high-duration growth stocks. It's not a full-blown flight to safety necessitated by, say, a geopolitical shock or a looming financial collapse. If investors feared a true systemic crisis, you'd almost certainly see gold as the ultimate currency hedge, spiking dramatically alongside energy. Instead, we see capital flowing towards tangible, inflation-resilient assets like oil and energy stocks, but not completely abandoning risk for pure haven assets like gold. It's a selective fear.
Right, very targeted. And finally, the currency markets. They always provide confirmation on global liquidity flows. What's the U.S. dollar index telling us this morning?
The dollar index is showing modest strength, up around 0.16%. This is classic risk-off behavior. When global investors become uncertain, they often liquidate assets denominated in other currencies and seek the safety and, frankly, the unparalleled liquidity of U.S. dollar-denominated assets. This inflow naturally strengthens the dollar index. And you can see that pressure visually in pairs like the euro versus the dollar, euro SD, which is hovering around 1.1614. It just confirms that capital is seeking refuge, and often that refuge, at least initially, is the dollar.
Okay, so we've confirmed the global caution. We've confirmed the rotation of capital. Now let's zoom right back in on the specific stocks driving the market, the winners and the losers. Where is that money flowing to specifically?
Yeah, the top gainers are a phenomenal illustration of exactly what the market rewards when the broader sentiment is negative. Take Vicker Corp, ticker VICR. It's surging over 30.3% in pre-market trading. Just incredible. The catalyst, an exceptional third-quarter earnings report.
Wow, 30%. Give us the numbers. What did they deliver to justify that kind of jump in this environment?
Okay, so Vicker, they're a power module manufacturer. They reported earnings per share of 63,000 cents. Now, this absolutely crushed the consensus estimate, which was only clustered down between $7.17 to 20 cents. I mean, we're talking about an earnings beat of over 200%. Revenue was also a major upside surprise, coming in at $110.4 million, significantly beating the $95.4 million forecast. Just a blowout quarter.
That level of outperformance suggests something really structural is happening in their business, doesn't it? Beyond just good cost management. What is Vicker actually doing in advanced power delivery that has the market so excited right now?
Well, the market cares deeply about their niche, their position in advanced power delivery, because it relates directly to the highest growth areas of technology. Think high-density computing, cloud infrastructure, AI hardware especially. These modern computing applications require power modules that are not just efficient but also incredibly small and need sophisticated thermal management. Vicker is excelling in this highly specialized, high-value area, and analysts are noticing. Craig Hallam, recognizing the strategic positioning, they upgraded VICR from hold to buy and aggressively raised their price target from $55 all the way up to $90. They specifically cited royalty potential from their tech. So this isn't just a one-off earnings bounce. It feels like a structural recognition of their crucial role in future computing architecture.
Very interesting. Next up, Winnebago Industries, WGO, jumping over 28.5%. I mean, beating estimates in recreational vehicles right now, given the squeeze on consumer discretionary spending. That seems astonishing.
It truly defied expectations, didn't it? Winnebago posted an adjusted EPS of 71 cents. That was substantially above the consensus estimate range of about 351 to 58 cents per share. Revenue was strong too, $777 million, easily outpacing the $726 million estimate. This performance suggests maybe consumer resilience, or perhaps more specifically, that the higher net worth consumers who tend to buy these big RVs are less affected by inflation and rate hikes than the broader market might have feared.
But here's where it gets really interesting, that analytical friction point. We saw the analyst firm KeyBank actually downgraded WGO immediately after this blowout report and the massive price surge. Now, if the market is punishing imperfection, why punish a company that just delivered perfection? Is this just irrational investor fear, or is KeyBank signaling that the macro ceiling is simply too low, even for winners?
KeyBank's move perfectly illustrates that tension between, backward-looking fundamental performance and forward-looking valuation. They downgraded WGO from overweight down to sector weight, and they explicitly cited valuation concerns. Essentially, what they're arguing is, yes, the company executed flawlessly, fantastic quarter, but the stock now, after jumping nearly 30%, fully reflects that performance. Their concern is that given looming economic uncertainty, specifically around consumer discretionary spending, higher financing costs for big-ticket items like RVs, the stock now has limited near-term upside potential at this new elevated price. It's actually a very rational call, even if it seems counterintuitive. They're saying don't chase the rally when the macro environment remains so risky. The market has priced in perfection. Now the company has to sustain it, which is a tall order.
That gives us a really rich look at where capital is flowing to. Now let's flip the coin and look at the stocks causing the systemic pain this morning, starting with the tech giant that really initiated this sell-off wave, Netflix, NFLX, down over 10.1% pre-market.
Yeah, the market's zero-tolerance policy was clearly brutally applied here. Netflix posted that EPS of $5.87, significantly below the $6.97 consensus. It's actually kind of amazing to think that one specific unexpected expense can just wipe billions of dollars off the market cap of a global giant like that. Netflix pinned the entire miss on an unexpected charge related to an ongoing tax dispute with Brazilian authorities. And while revenue and subscriber numbers were generally okay, maybe even good, that bottom line miss was just seen as sloppy execution in an unforgiving climate. And that perceived messiness is now casting a shadow over all high-growth stocks, really confirming the need for tight risk management from investors.
And that Netflix tax issue feeds directly into the broader tech pessimism, which is evidenced by Texas Instruments, TXN, also down significantly over 5%.
Right. TXN's disappointment is arguably acting as a far more important bellwether than Netflix for the actual manufacturing economy. Texas Instruments is a foundational supplier of analog and embedded chips. They go into everything from cars to industrial equipment to personal electronics. Their cautious outlook strongly suggests that industrial demand and general technology hardware demand might be slowing down faster than people anticipated. This really heightens feels of a classic cyclical downturn in the chip industry, and it's causing broad declines not just in TXN itself, but across the entire semiconductor supply chain.
Okay, shifting gears a bit to the really high beta names. Hut 8 Corp, HUT, a digital asset miner, is plunging over 17.2%. That really smells like aggressive profit-taking in a highly volatile sector, doesn't it?
Oh, absolutely. It's a textbook high beta reversal. Hut 8 has been on fire recently, riding that momentum wave fueled by the Bitcoin rally. In a risk-off environment like today, these high-volatility, momentum-driven stocks are often the very first ones investors sell to raise cash or lock in those quick profits. And the drop isn't isolated. It's part of a broader sector sell-off in crypto-related equities. Peers like Galaxy Digital, Bitfarms, they're also down double digits, over 12%. When sentiment shifts abruptly from risk-on momentum chasing to risk-off de-risking, these are the stocks that feel the brunt of the volatility swing.
And we saw that conflicting narrative play out really sharply here, right? A huge price target hike from one firm just recently, but then cautionary comments from others.
Absolutely. Piper Sandler had just recently raised its target way up to $74, citing the continued Bitcoin excitement. But when the market tide turns sour like this, those long-term price targets suddenly look secondary to immediate profit-taking. Commentators like Jim Cramer, who had advised investors to, quote, ring the register on some of these high flyers, well, they proved prescient this morning. This volatility just underscores that in these highly momentum-driven, high-beta names, technical indicators and shifts in sentiment often trump fundamental news flow, at least in the very short term.
And finally, on the losers list, Centrus Energy Corp, LEU, dropping over 16.5%. But apparently with no immediate negative catalyst. What's driving that kind of selling pressure?
Yeah, Centrus Energy, which focuses on nuclear fuel and related technologies, has been an absolutely stellar performer, returning something like 237% over the past year, just a monster run. When a high-performing, volatile stock like that experiences a significant pre-market drop without fresh bad news, it's almost always attributable to two main factors: good old-fashioned profit-taking and technical weakness. The stock was already flagged in some technical reports as being potentially 22% overvalued after a recent price rise. So, in a risk-off environment, any stock perceived as stretched or overbought, especially after such a massive rally, just becomes a prime target for rapid liquidation as people lock in gains.
Okay, that detailed the micro stories brilliantly. Now let's pull the lens back out again to the macro drivers. The things that hold the power to either accelerate this caution or maybe provide a path to stabilization. We have to focus on the economic docket.
Right. We start with today's releases, Thursday, October 23rd. The first significant report drops soon. Initial jobless claims at 8:30 a.m. Eastern Time. That's our classic early indicator of labor market health.
What are the expectations for the claims data this morning, and how might the market interpret any surprise, high or low?
Okay, the consensus forecast calls for 223,000 new claims. That's a slight tick up from the prior week's 218,000. Think of this as the real-time pulse of potential layoffs. If the number comes in significantly higher than expected, let's closer to 250,000, that would definitely fuel recession fears, reinforce the negative sentiment we're seeing, and likely accelerate the move towards defensive stocks. Conversely, a lower number below expectations would reinforce the resilient labor market narrative. But honestly, given the current earnings stress, a good number might only provide a brief temporary stabilization before the market immediately refocuses on inflation and tomorrow's CPI.
Okay, and later this morning, 10:00 a.m. Eastern, we also have existing home sales. What's the significance there?
The forecast there is for 4.1 million units, seasonally adjusted annual rate. That's a small increase from 4.8 million prior. The significance here is really gauging the impact of the sustained high mortgage rates on housing activity. A weak number would suggest the housing sector is seizing up due to unaffordability, which is a pretty significant headwind for the broader economy. We'll also monitor a couple of secondary indicators like the Chicago Fed National Activity Index and the Kansas Fed Manufacturing Index later today. They provide early reads on industrial health and the overall growth trajectory.
But as we both stressed earlier, the critical event, the one determining the path for interest rates, for valuations, it's Friday's CPI report. We really need to dig into the details on the inflation dynamics here.
Absolutely. This is the moment of truth for the week, scheduled for Friday morning, October 24th, 8:30 a.m. Eastern. The Federal Reserve has that dual mandate, maximum employment and price stability. With employment still looking pretty strong, their entire focus right now is squarely on price stability. That makes the CPI print arguably the most consequential piece of economic data for markets.
Let's define the nuance for listeners. The market tracks two critical components: headline CPI and core CPI. Why do we look at both, and what are the specific consensus forecasts everyone's watching?
Right, we track both because they tell slightly different, though related stories. Headline CPI includes those volatile food and energy costs, the prices you and I see every day at the gas pump and the grocery store. The consensus for headline CPI year over year is actually expected to rise slightly to 3.1%, up from 2.9% in the prior report. This expected increase is largely due to that recent spike in crude oil prices we discussed, which directly impacts the headline figure.
Okay, so headline might tick up. What about core CPI? Why is that the number the Fed, and arguably the market, pays even closer attention to?
Core CPI strips out those volatile food and energy components. It focuses instead on services and goods where price changes tend to be stickier and more reflective of underlying structural inflation pressures. Things like rent, services, especially wage growth impacts. The consensus for core CPI year over year is expected to be 3.1%, which would be flat, unchanged from the prior month. The fact that core is expected to hold steady, even as headline rises due to energy, suggests that maybe, just maybe, while commodity inflation is hitting consumers, the structural inflation pressure might be plateauing. And that's a critical signal the Fed needs to see confirmed before even thinking about a policy pause or pivot.
Okay, this brings us to the crucial scenario analysis. What happens if this print comes in hot? Let's say core CPI comes in higher than that 3.1% expectation. What's the immediate market reaction?
A hot print is basically the market's worst-case scenario right now. It signals that underlying inflation, particularly sticky services inflation, is not moderating despite all the rate hikes we've had. This guarantees a more hawkish Federal Reserve. It increases the likelihood of further rate hikes, or at the very least, keeps rates elevated for much longer than the market currently anticipates. Tactically, this would probably send bond yields soaring again, significantly increasing that discount rate applied to future corporate earnings. That would put massive downward pressure on high-duration growth stocks, accelerating the kind of tech sell-off we saw with Netflix. You'd likely see the Nasdaq significantly underperform the Dow again. Investors would probably run further into tangibles, energy, value stocks, anywhere but long-duration growth.
Okay, that's the bad news scenario. What about the reverse? What happens if we get a cool print, say, core CPI unexpectedly dips below 3.0%?
A cool print would be a massive relief rally catalyst, almost instantly. It would alleviate a huge amount of market anxiety by suggesting the Fed's tightening measures are finally working effectively on underlying inflation. This potentially gives the Fed room to consider pausing their rate hikes sooner, maybe even hinting at future cuts down the line, though that's further out. Yields would likely drop significantly, making future cash flows more valuable, especially for growth companies. This scenario is the best hope for the currently stressed technology and growth stocks. It might allow the market to view the current earnings weakness more as a sector-specific correction, a necessary reset, not a full-blown macro disaster. The Nasdaq would likely rally strongly on that news.
And the middle ground, what about an inline print, where we land exactly on that 3.1% consensus for core?
An inline print probably maintains the status quo, which is this environment of heightened caution and uncertainty. It would confirm inflation is plateauing, which is good, but maybe not receding rapidly enough for the Fed to relax just yet. This likely means the Fed remains patient, data-dependent, and certainly won't signal any immediate rate cuts. The market, in that case, would likely shrug off the macro number after the initial reaction and focus intensely back on the micro, specifically the earnings reports that come out today, especially Tesla tonight. It buys the market time, but it doesn't really solve the core uncertainty.
Okay, let's move to that corporate roadmap then. Yesterday's tech wreck definitely set the tone, but today's aftermarket report from Tesla, that could either stabilize the whole sector or just accelerate the carnage.
Absolutely. And before we look right ahead to Tesla, let's just briefly recap the full scope of Wednesday's tech pain, because it was broader than just Netflix. We saw International Business Machines, IBM, listed as a top Wall Street faller. It was down about 2.67% in extended hours, suggesting pretty underwhelming guidance. Lam Research, LRCX, a key semiconductor equipment provider, slid 2.61%. That confirms the pessimism is sweeping across software, hardware, services, and even the companies that make the chip-making tools. It's a wide technological malaise right now.
But the main event tonight, no question, the biggest test for high-growth stocks this week, perhaps, is Tesla, TSLA, reporting after the market closes.
Yeah, this is arguably the most anticipated earnings report of the entire season given Tesla's weight and influence. Expectations are being highly scrutinized. The consensus earnings per share estimate is hovering around 50 cents per share. Revenue estimates are in a fairly tight range between maybe $24.55 billion and $25.18 billion.
Okay, beyond just hitting or missing those headline numbers, where should investors like you be laser-focused tonight to really determine the stock's future trajectory? What's the key metric?
It all comes down to profitability, specifically profit margins. Without a doubt, Tesla has engaged in really aggressive price-cutting and marketing campaigns globally over the last year or so, trying to stimulate demand in an increasingly competitive EV market. Investors need to assess the real quantifiable impact of those cuts on gross margins and operating margins. Any further significant deterioration in those margins will signal a deeper struggle to balance volume growth against profitability. Management commentary is also key. Future production targets, delivery guidance, and crucially, any signals on demand, particularly from China, will be instrumental. Given the already weak tech sentiment, honestly, a weak Tesla report tonight could just pour fuel on the fire and accelerate the broader growth stock sell-off quite dramatically.
We also have other critical high-profile reporters today. Who else should we be watching, both before the open and after the close, that could provide important sector clues?
Okay, before the market opens this morning, keep an eye on AT&T, ticker T. Consensus EPS there is $0.54. That gives us a read on telecom and wireless health. We also have CME Group, the big exchange operator, Thermo Fisher Scientific and Life Sciences, and the private equity giant Blackstone, BX, all providing different insights into financial markets, healthcare, and alternative investments.
And after the market closes tonight, besides the event Tesla, we also get Intel. That feels critical for the semiconductor sector's potential stabilization, especially after that TXN disappointment yesterday.
Intel, INTC, is absolutely paramount for stability in that space. The market desperately needs to see some evidence that Intel's costly turnaround efforts are actually translating into improving results and, more importantly, better guidance. Its results will be intensely scrutinized for signs of recovery or further deterioration in PC and data center chip demand. We also have Ford Motor Co., F reporting after the close. That gives us an insight into the traditional automotive sector's ongoing battle with high labor costs and that difficult, expensive transition to electric vehicles.
And then looking ahead to Friday morning, after the crucial CPI dust hopefully settles, we get a view into the oil giants. That takes us full circle back to our theme of energy strength this week.
Precisely. Chevron, CVX, and ExxonMobil, XOM, both report before the market opens on Friday. Given that powerful surge we've seen in crude oil prices recently, these reports will be watched extremely closely. The market expects significantly boosted profitability, and investors will be listening very closely to management's outlook on global energy demand, their capital spending plans, maybe shareholder returns. Strong results here would really validate the current rotation into the energy sector that we've been discussing.
Okay, this has been a really complex picture this morning, defined by this tension. Let's try and synthesize this conflict between the micro-level repricing of tech risk and these looming macro threats.
Yeah, the current state is definitely precarious. You've got this micro-level repricing of technology risk triggered by specific poor earnings from bellwethers. But that micro-trigger is causing a significant macro effect. This broad systemic defensive rotation out of growth and into value, industrials, and inflation hedges like energy. The entire market feels like it's holding its breath, highly sensitive to the interplay between tonight's corporate fundamentals, mainly Tesla, and tomorrow's crucial inflation data from the CPI report.
So what are the dual risks really facing the market over the next, say, 36 hours?
Well, the immediate risk is tonight, a negative surprise from Tesla earnings. If Tesla confirms that those aggressive price cuts are really gutting their margins, it basically validates the current bearish sentiment and could accelerate the growth stock sell-off across the board. Then the looming risk, the potential systemic worst-case scenario, is that hotter than expected core CPI print on Friday morning. That would combine the existing fear about growth stock margins and valuations with renewed inflation and interest rate fears. That's classic stagflationary anxiety, right? And it leaves investors with very few perceived safe assets to hide in.
So the path to stabilization, then, requires basically the opposite sequence of events.
Exactly. Stabilization likely requires resilient earnings, especially from market leaders like Tesla, suggesting their profit models are more intact than feared, and that positive micro news would need to be coupled with a cool or at least perfectly in-line CPI print tomorrow morning. That scenario, good earnings plus cooling inflation, could allow the market to potentially write off this current pullback as more of a healthy, sector-specific correction, a necessary flush of some high flyers, rather than the start of a broader structural downturn.
Fascinating. Okay, to leave you, the listener, with one final provocative thought to mull over today. We noted earlier that while the VIX, the fear gauge, signals heightened alert, it does remain below those true panic levels. So the question you really need to grapple with right now is whether the current market action is just a tactical, short-term reaction to specific known bad news, meaning it could potentially reverse quite quickly with just one strong positive catalyst, like maybe a surprisingly cool CPI number tomorrow.
Or is this the beginning of a genuine structural shift, a fundamental repricing of risk, where high-duration growth assets like big tech are going to be permanently valued lower because of structurally higher long-term interest rate expectations? If it is structural, well, then investors might need to fundamentally adjust their long-term portfolio strategies, moving beyond the simple assumption of the last decade that technology leadership will always just bounce back stronger. These next 36 hours, with Tesla tonight and CPI tomorrow, will be absolutely instrumental in answering that crucial question and likely determining the direction of capital flows for the rest of the year.
The battle is joined, the data is becoming clearer. That was our comprehensive morning briefing for the Bulls, Bears, and the Bell Morning Edition. Thank you for diving deep with us today.